Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is one of the most popular restaurants a good investment? In this video we will be analyzing if Cava stock is a buy. Will Cava stock ticker symbol CAVA climb even higher? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Cava. Cava was founded in 2006 by three friends in Maryland focused on providing fresh, customizable bowls and salads packed with flavorful ingredients inspired by the Mediterranean. After opening their first store, the company quickly gained a loyal following. Fast forward to the present, Cava has grown into a successful chain with over 8,100 employees, with nearly 300 locations, and is headquartered in Washington, D.C. Now let's look at the price action. Starting with the chart, we see that Cava had a CAGR of about 85%. Cava's share price has done very well over the past 12 months, and the momentum does not seem to be stopping. If we perform a backtest comparison of investing $10,000 in Cava versus the S&P 500, we find some excellent results for Cava. In that comparison with the S&P 500, $10,000 invested in Cava would have grown to $17,568 or a 76% CAGR versus $11,447 or a 14% CAGR if invested in the S&P 500. This demonstrates outperformance for Cava. A Cava investment would have also been more volatile with a 75% standard deviation versus 16% for the S&P 500. Cava outperformed the S&P 500 in terms of the best year performance, for which Cava grew 67% versus S&P 500 8%, and worst year performance where Cava fell 5% versus the S&P 500 6% fall. In terms of max drawdown, Cava fell 46%, nearly 6 times more than the max drawdown of 8% for the S&P 500. Cava outperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Cava clearly outperforms the S&P 500 in nearly every metric. Now let's take a look at the fundamentals to learn more. Gross margin is 37%. This is pretty good for fast casual restaurants. Revenue has compounded at around 21% over the years and has reached over $729 million most recently. Cava's revenue is growing very nicely. Looking at cash flow, we see a 429% CAGR since 2022 for operating cash flow, while capex has worsened at a 57% CAGR. As a result, free cash flow has improved at a 11% CAGR. Cava has done a very nice job of growing operating cash flow and seems to be emerging from a heavy investment period. If trailing 12 months capex stays below $139 million, I would expect an acceleration on the move to free cash flow positivity. Weighted average shares outstanding have grown a lot over the years, going from 1.2 million shares in 2022 to 63.5 million shares most recently. Cava has been diluting shareholders. It is important to note that even though Cava went public in 2023, there still has been shareholder dilution. This is one of the big problems with companies that are free cash flow negative. Now let's view return on invested capital. Return on invested capital has increased over time, going from -1% in 2023 to 2.4% most recently. Though I do not expect this value to remain positive while free cash flow is negative, it is nice to see that the company is improving the efficiency of their investments. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -7 days in 2022 to -7 days most recently, Cava has actually maintained its efficiency over time. They must have some great deals with their suppliers. Last, let's look at Cava's debt. The net debt to EBITDA has decreased over time, going from 52.7 in 2022 to 0.1 most recently. Cava has reduced their net debt significantly. Unfortunately, given their negative free cash flow status, it is possible that management will take out more debt to fund operations in the future if the company doesn't become free cash flow positive in time. Cava looks to be doing really well for a quickly growing company. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the food fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Cava. It is a restaurant company with a gross margin of 37%. The revenue per share CAGR is -87% and the free cash flow per share CAGR is 90%. Despite a decent gross margin, shareholder dilution has really hit revenue per share growth. Free cash flow is still negative but less negative than 18 months ago, which is why the free cash flow per share growth looks so high. A return on invested capital of 2% is very low but seems to be improving. Next, the cash conversion cycle of -7 days is actually pretty good. If Cava can maintain this, then it will be another catalyst in the drive for efficiency at the company. Concerning debt, a net debt to EBITDA of 0.1 means that it would take Cava a little over 1 month of earnings to pay back their debt. So from a fundamental standpoint, Cava does look good pretty for a newly public company. Now on to valuation. Cava is massively overvalued relative to the S&P 500 with a ratio of 12.3. The price to earnings growth, or PEG ratio, is 21.1, indicating that Cava is again massively overvalued relative to their projected earnings growth. Cava has been one of the best restaurant stocks to hold this year, coming in second to Sweet Green. Cava's share price has appreciated 89% year to date. The company is clearly resonating with investors and has the fundamentals to back it up. Growing revenue and operating cash flow along with healthy gross margins have placed the company on a good trajectory. While it is still early, free cash flow is slowly moving towards positive territory. The big challenge for Cava is managing growth while moving towards positive free cash flow. If they spend too much on capex in an effort to drive revenue growth, they will deplete their cash reserves and require the company to raise more capital via debt or equity offering. However, if they do not invest enough in capex, it will take too long for revenue to grow enough to cover capex spend, and the company will have to raise more capital via debt or equity offering. The good news is that the sweet spot for capex spend does seem achievable, with positive operating cash flow, $332 million in cash, and capex at $139 million annually. Cava has over 2 years of runway. It is crucial that the company become free cash flow positive before 2026. I actually don't think Cava will need to raise additional cash but will continue to dilute shareholders very slowly until they can initiate widespread share buybacks. The earliest I can see for buybacks is 2026. The other big issue for potential shareholders of this company is the valuation. It is massively overvalued and has a large chasm to cross to grow into its valuation. I am looking for a 50% cut in valuation, which may never actually happen. However, I think one catalyst for a drawdown may be consumers beginning to shift from eating out at restaurants. Several articles have noted that consumers are beginning to pull back from restaurant spending. While most of the restaurants that are currently feeling pain tend to target lower-end consumers, it is entirely possible that those price constraints will move up market. In my opinion, Cava is a really good early restaurant company that is massively overvalued. I am looking for a pullback, and for me, Cava is going on the watch list. Many thanks for watching. What do you think about Cava and their valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.